Good day and welcome to this broadcast brought to you by Satrix. My name is Gielie de Swardt and I head up the retail distribution function at Sanlam Investments, and I will be your host for our session today. With me I've got Kingsley Williams, the Chief Investment Officer, and Nico Katzke, the Head of Portfolio Solutions, both at Satrix. Before we get started, I want to invite you to utilize the Q&A function at the bottom of the screen to ask us any questions that you want Kingsley and Nico to answer afterwards. Secondly, we have applied for CPD points and we will keep you updated with the outcome of these applications. So, gentlemen, welcome. We're not going to waste a lot of time with formalities. Let's get right into it. Kingsley, recently Netgroup released their core chart book where they highlight global as well as local trends in terms of indexation strategies or rules-based strategies. Can you maybe share with our audience the key findings of the report, but also maybe some specific Satrix things that you want to highlight from that report?
Yeah, sure. Thanks, Gielie, and thank you to all the listeners for making the time to join us today. As you can see on the chart, this Netgroup research that gets done looks at indexation or rules-based strategies globally. And what the chart is showing is that 31% of global assets are now in some form of systematic or rules-based or indexed type investment strategy. So you'll see that in the light blue shaded section. And as I mentioned, as at the end of 2021, 31% of all assets are managed according to some sort of systematic strategy. And that's up from 29% a year prior and up from 14% a decade prior. So you can see where the growth in the industry and the trend in the industry has been. It's very much been moving to systematic and sustainable strategy, systematic and rules-based or index strategies. And to sort of illustrate that in a different way, if you look at the chart on the right, this shows you the flows into rules-based or indexed strategies relative to the flows in active strategies, which are shown in dark blue. And I think what's quite interesting with this chart is that you'll see the more consistent inflows into indexed strategies as opposed to more erratic flows into active or traditionally active strategies. So I think that's been a very dominant theme that's shaped the global landscape. And obviously what we know from other studies that have been done is that the US is really at the forefront of adopting these indexed strategies, particularly the ETF segments of the market, where more than half of assets, particularly in the equity space, is made up of indexed strategies in one vehicle form or another. If we move on to our local market, we actually see the same trend unfolding. So what this chart shows is the growth of rules-based and indexed strategies across all the different vehicle types. So in yellow, you'll see the segregated mandates, our CIS funds in both unit trust and ETF form in the two shades of blue, as well as life pooled vehicles in red. And you'll see that growing share of AUM that makes up the indexation industry within South Africa. So we're seeing that same trend unfold in our local market. Now, we've actually done some analysis locally as at the end of December, looking at the listed equity space. So that includes all of the categories in the listed equity space, as well as the listed property segments within the ASISA categories. And what we found was quite interesting. It actually surprised me when looking at this initially, is that some 14, even in excess of 14% of AUM is now managed according to some form of index or rules-based strategy of the total CIS market. Split roughly 55% in favor of unit trusts and 45% towards ETFs. So that was quite a high, it was higher than what I was expecting, and I think it also is indicative of the growing take-up of indexation strategies in our market. And then if we zoom into that indexation subset, we've also done some further work in splitting and categorizing funds that follow a more vanilla approach, which would, at Satrix we refer to anything that's market cap weighted as being a vanilla strategy, what most investors would typically term passive. But then we've also identified the funds that track an index but are not necessarily following a market cap weighted index. So those would be your smart beta, your factor strategies, and various other thematic strategies. And you can see that those non-vanilla strategies make up in excess of a quarter of the AUM within the indexation subset. So there's definitely been a growing adoption of indexation strategies in our market. Now, if we look into the rules-based segment of, the high equity multi-asset space, so this is where most of your balanced funds operate. What this chart shows are the rolling 12-month flows of that category overall, shown in the green and the red shaded area. And then we've also split it out into various subsets. So you've got the largest 10 actively managed balanced funds in that subset, and you can see that they dominate the AUM and the flows within that category. And then we've also split out the rules-based balanced funds, also known as balanced index funds or passive balanced funds. And what's quite interesting with this chart is you can see, particularly during 2020 and 2021, that there were significant outflows out of this multi-asset high equity category, particularly amongst the largest 10 actively managed balanced funds. But what was also interesting is that in that period, we had some of the largest flows into rules-based or indexed balanced funds. And what's quite interesting over the year of 2022 is that more than a third, so in other words, more than 1 in every 3 rand of net flows that went into this high equity balanced category went into rules-based or systematic balanced index funds. So that really speaks to the growing adoption of indexation strategies in our market. And while the absolute AUM might still be quite small, this really lifts the hood up in terms of where flows and new rands are being invested in our market and the growing adoption of indexation in South Africa. So this is a trend that is unfolding globally, but we're very much seeing it play out locally in South Africa as well. So if we have a look at Satrix's AUM, we've obviously been a big beneficiary of that shift towards clients increasingly adopting indexation strategies in our market. And you can see across a range of different types of category or strategies that we offer, whether it's vanilla locally, factor strategies locally, offshore strategies, or multi-asset strategies. You've seen a very healthy take-up and growth over the last few years with our AUM. And that number at the top of each bar represents our AUM at the end of each year, our total AUM. Last year was a tough year. There was pretty much nowhere to hide for investors across asset classes, locally, globally. Yet our business still managed to grow in the face of that negative market movements that most investors were subjected to. And this is, again, thanks to our clients for the support that they've given us and the ongoing flows and take-up of our strategies. So I want to just thank clients for their ongoing support. And the other thing just to highlight with our AUM is that this AUM has grown off the back of third-party clients. So while we are supported by the Sanlam Group and very much integrated within the Sanlam ecosystem, we aren't dependent on Sanlam's allocations to this business to grow. The market more broadly has adopted Satrix strategies within their portfolios across a variety of different investment vehicles. So we're delighted with that, and we aim to continue serving clients and providing the great returns that we've done since the beginning of Satrix's history.
Well, Kingsley, thank you very much for sharing that. But Nico, let's be fair, that's ultimately historical data. Can you maybe share with our participants what we can expect from your point of view going forward?
It's a great question, Gielie, because at the end of the day, if you look back, that gives you one indication, but let's look ahead and, don't take our word for it. It's always a good premise to start. Boston Consulting Group did some really interesting work where they created a chart showing on the x-axis, as you can see on the screen, the net revenue margin. So in other words, how much revenue are the funds making, and then on the y-axis you see the estimated AUM growth from 2020 to 2025. And interesting, the areas of growth that we highlight there are particularly in the equity ETF space as well as the fixed income ETF space, that you see the highest amount of projected growth going forward in the next 5 years. So certainly speaking to indexation, not only being at a high and robust level globally, but where we expect to see increased flow. And as Kingsley showed, we're seeing that locally. We are seeing that within systematic funds in the balanced fund range, but specifically there's quite a healthy flow. But what we project is that in future our market will align with the global experience of seeing more flow into the lower margin funds. And as you can see, we also highlight there the passive equity as well as passive fixed income. That would be your unit trusts that have a indexed approach to it. So definitely we're seeing more flows into rules-based strategies globally as well as locally.
Well, thank you, Nico. Yeah, when we engage with our clients, it doesn't take long for the cost benefits to always come to the front or the fore when you talk about indexation strategies. There is a clear cost benefit, but are there more benefits to that clients do get from it, or is it purely a cost play?
That's such a great question, Gielie, because at the end of the day, indexation has always been framed around cost benefits. And what we at Satrix try to communicate as clearly as we can is that there's much more than simply cost saving when it comes to index investing. In fact, there's two great reasons to consider indexation. The first is the predictability around design as well as implementation, the consistency with which styles or themes are being captured and packaged within an index strategy. In other words, you get what is inside, it says on the tin. And so, that level of predictability is highly prized by investors. A second reason for considering indexation and why we've seen this growth, because you always need to ask why. If we project sustainable growth, why would that be? So the first is the consistency, and secondly is the performance. So if I show you the next slide, so if we consider the MSCI World Index, now this is we offer this as a feeder ETF in South Africa. Now the design of this index, it's has close to 3,000 companies invested in it. It is a large index. It is well diversified, spread out across the globe. So from that perspective, it's a highly efficient index being tracked. Now, on the zero axis, you see the performance on a rolling 3-year basis of the MSCI World Index. So in other words, we normalize everything to that performance. So it doesn't mean a zero performance. It simply means if you are on the gray line, the gray horizontal line, that is performance in line with the index. Now, what's interesting is, so we subtracted 30 basis points annual free from this index to give you a proxy for what your invested rand in this strategy would have actually earned. Now, if you compare this to the global active manager spectrum, and here we did some interesting work where we included, about 3,000 funds that track this index, explicitly track this index, and we compared their performance on a rolling 3-year basis. Now, what is fascinating to see is that the index actually performed in line with the top dark blue shaded area, which is the top and the bottom quartile. So and the light shaded area, that is the top decile. Now what's interesting is if you track this over the last 10 years, this index actually performed in line with the top quartile, if not top decile of active manager performance. Now you have to ask why this is the case. And if you think about how efficient this market is, this global market for investing in equities, you start to see palpably how clear it is if you have a cost-saving exercise implemented in your portfolio, how hard it is for active managers to actively differentiate themselves from this index return. And especially if you look at it over a meaningful period like 3 years, for example. So the performance of indexation certainly speaks for itself, and it's becoming harder to motivate why you're not considering it as part of your portfolio. Now, the local case is exactly similar. What we did here, and it's, we have shown you in the past, Gielie, quite a few times, we've shown you the performance of active managers relative to the benchmark that they track, as we did on the previous slide. But let's be a bit more conservative. Let's look at the entire spectrum of indexation strategies. So this includes vanilla, as well as the non-vanilla indices like styles, for example, momentum, quality, value, as well as certain themes. Now, if we bucket all the locally available index strategies within the South African Equity General ASISA category, what you see is that the green shaded area, that is the times where on a rolling 12-month basis, your median index performance outperformed your median active manager. Now, this is fascinating because, again, you would expect our intermediaries to add their value by tilting towards certain styles that they believe will be in favor or out of favor, or tilting towards vanilla, for example, during periods like you see there, 2018 to 2019, where indices did exceptionally well relative to active managers. So if we abstract away from that and purely look at indexation as a group, you still see that indexation outperforms active managers more often than not. And now, of course, the value that lies in the world of intermediaries is actually being able to tilt when certain indices might be in favor and when certain styles may not. Now, if we look at 2020, What you see on the right, that is now the performance of your index strategies in South Africa, available index strategies. And on the left, those are the active managers and their past, their 1 year performance. Now, one thing stands out immediately. I shaded the green dots on the right side. That is your value strategies, right? So your Satrix Divi or RAFI indices or anything, any index or rules-based strategy that had value in its name. You see it highlighted in green. So notice how well these funds actually, these rules-based funds aligned to value actually did in 2022. I also highlighted momentum and growth strategies in red. And it's for the same token, look at how comparatively poor your growth strategies had performed. And we'll be discussing more around the nuance between when certain styles perform. But it's very clear that were intermediaries or investors able to allocate more towards value styles, they would have performed exceptionally well during this period. Also, what I want you to notice from this slide is the dispersion of active manager returns. So just a wider dispersion. We see this time and time again. If you look at this same plot over many years, you see this, that the active manager dispersion is quite significantly broader, and that the dispersion of your index strategies are narrower. In other words, less volatile type of return structures. Now contrast this is the 2022 performance. Contrast this to the period in 2019. This is now a period that was dominated by momentum and growth-oriented strategies, and a period where, or a year where value strategies actually underperformed. Now, herein lies the value that intermediaries can add to their client portfolios, is being able to tilt towards certain styles that are likely to be in favor and understanding the fundamentals that drive the returns for these different styles. Now, you know, a logical retort to this would be, well, you know, if the active manager that we are investing in is more often than not a top quartile or a top decile performer. So indexation is less relevant in my life because I have the ability to pick, you know, the next winner, so to speak. What this graph shows, and just to provide some insight in terms of how hard it is to actually be able to maintain a high level of performance for active managers in South Africa. What we did here is we looked at every year in the past 15 years. We stacked up the performance of active managers. So every line that you see on this chart is an active manager. The color of the line for a given year indicates the performance of that active manager for the past 3 years. So in other words, let's take a year there, 2015. Notice that right at the top, the top performing active manager was a green line, indicating that the top performer in 2016 had a good, or in 2015, sorry, had a good performance for the 3 years prior. Now, if there was high persistence in performance, all the green lines would be in the top. In other words, the past 3 year performers would be the current best performers, and all the red lines would be at the bottom. But what you see in practice, Gielie, is that there's a dispersion every year. In other words, some red lines are at the top, some green lines are at the bottom. What's interesting and I suppose quite poetic is if you look at 2022, the correlation above each of those bars give you the correlation of past performance and current year performance. And if you look at 2021 and 2022, you see that for both years the correlation has been very close to, if not 0%. In other words, past performance has been a very poor, if any, indicator of current performance. And so taken together, and it's a long-winded answer to your question, but taken together, the value in indexation lies within its consistency in design and its great performance, as well as cost, and it's not only a cost exercise.
Yeah, thank you very much for that, Nico. So Kingsley, we know that 2022 was obviously a very challenging year. Can you maybe start off by giving us or taking us through a brief summary or overview of the performances of the various asset classes that you do follow from a Satrix perspective?
Yeah, sure, Gielie, thanks. On this slide, you'll see the names of various headline indices that we have exposure to across our range of products, and some of the key indices that we also use within our multi-asset balanced funds. So what I'm showing you initially here is the performance over the last 6 months, given this is a semi-annual 6-month update, so that's quite useful to see, as well as over the last year, shown in dark blue. And you'll certainly see that over the last 6 months, there was actually quite a strong recovery in markets, led primarily by listed property locally, but followed closely by local equities. But if we have a look over the last year, over the last 12 months, it it was a tough place to be. We had some marginally positive returns from our local asset classes, but you'll see at the bottom of the slide, I've got CPI there, and that refers to inflation. And that's the reason we ultimately invest. We're trying to invest for the long term to ultimately beat inflation. So you don't want to be leaving your money under the mattress or in a bit of furniture, as has often happened. So you want to be investing for the long term to try and deliver an inflation-beating return. And as you can see on this slide, over the last year, nothing beat inflation. Everything was behind inflation. So in real terms, everything made a loss. But that's not the reason, well, that shouldn't be the time horizon that we're investing for. It takes time to generate inflation-beating returns. So if we have a look over the medium term, and I would define the medium term as over 3 to 5 years, I've highlighted that vertical line there is referring to inflation over the 5-year period. You can see that our local equities pretty much just kept pace with inflation, so didn't lose value in real terms, but didn't really deliver an inflation-beating return, although over the 3-year period, there are actually substantial returns that came through from local equities. So that's encouraging to see. Obviously, the standout underperformer there is listed property, so a bit of a recovery over the last year, over the last 6 months, but not enough to offset the significant losses that we've had in that space. But the real standout performer has been global developed market equities. So you'll see that with MSCI World, phenomenal returns in rands from having invested offshore in developed markets, and that's really off the back of the US driving those phenomenal growth, those phenomenal growth stocks in the US in the tech space, delivering exceptional returns. What's also interesting is quite a defensive asset class, what we would deem quite a defensive asset class, and one which we've now included in our multi-asset balanced fund range, is global infrastructure. So this is listed infrastructure, not unlisted. It's accessible in an index. It's an index that represents listed infrastructure companies that are listed on stock exchanges, similarly delivering exceptional returns over that 3 and 5 year period. But then when we look at longer term periods, so that would be over 10 years in orange, or going back almost in excess of 20 years in the dark grey, black shaded bars, you'll see that returns largely follow the risk that you would expect with each asset class. So local equities, local property delivering healthy above inflation returns, particularly going back to February 02. And as you would expect with less risky asset classes like nominal bonds, tracking the All-B index, or our inflation-linked bond index, you'll have lower returns from those asset classes, which is consistent with their risk-return profile. So I think that gives you a good summary of what's taken place. And I think this highlights why investors should stay the course over the long term, because it takes time for these risky asset classes to deliver their returns.
Yeah, Nico, to build on what Kingsley just said, can you maybe share some further insights on the drivers of performance during 2022?
That's a very simple answer, Gielie. It was all value. Globally, we saw any strategy that had value in the name performed well. We saw that locally. We saw it globally. If anything, our market is consistent there because value was a key driver in the local market and it was a key driver in the global market. What I want to show you, and initially when I first showed you this graph, it was all in the negative territory. So as Kingsley mentioned, 2022 was a bloodbath on global equity markets. But what we saw is if you reorganize this slide to make the MSCI World Index the de facto benchmark, so if we say the global equity performance was, on aggregate was the MSCI World Index, which I wouldn't think is too strange a statement to make, then look at the performance of different indices relative to MSCI World. So in other words, where there was pain and where there was gain. So pain was everywhere, but where was relative gain? So if you look on the left side, your momentum index, MSCI momentum, MSCI quality, pain was felt in momentum and quality indices. And when we discuss styles, particularly a bit later, it's always important to remember that momentum as an index, it's almost like a container ship. It takes a long time to turn. So if sudden events happen, like we saw Russia invading Ukraine, momentum is the first style to struggle because it's still heading in a certain direction and we see a sudden pivot. So all of a sudden you see energy markets in turmoil and you see a sharp correction in certain indices. So momentum will then continue to actually be exposed to the companies or the sectors and the indices that performed in the past but no longer perform. And it takes a bit of time for momentum to adjust. Where the interesting thing is where we see particular pain is within the growth sectors. So if you look at the MSCI growth, the NASDAQ, the S&P 500, the Nikkei, various indices, and we actually did a bit of research recently that shows how much aligned global indices have become towards growth as a strategy. So growth as a strategy particularly struggled. Where you see a relative gain is on the value side of things and also on the EM side, where there for years has been said there remains quite significant value. So MSCI India, for example, did exceptionally well. Our own index, the All Share Index, did extremely well in a comparative sense in dollar terms on the far right there of your screen. We also see that infrastructure, and as Kingsley mentioned, also did well. And I think it's a sign of the times when infrastructure does well. There's an indication, almost a feeling that governments will continue to spend more on infrastructure development, particularly as it's becoming harder to actually stimulate economic activity through monetary policy. So, you know, as you well know, and I don't need to tell you this, central banks have been on a tightening spree. So it's harder to stimulate economies through monetary policy. So of course fiscal policy steps to the plate, and this is where you see more spending and more investing in infrastructure. So infrastructure has absorbed quite a bit of flow, but you know, MSCI value, MSCI divi, this is where the performance certainly was felt most acutely. Now to put this into perspective, right, if we look at the spread between MSCI quality and MSCI growth and MSCI value, currently as at end of December, the MSCI value index has seen the highest spread relative to growth since the dot-com crash, right? And this is now fascinating to unpack. Why? Why is it the case that value strategies locally, globally have done so well? In fact, historically well. We have to go back all the way back to, you know, where pets.com was still a thing. So the reason value has done well recently and growth has done poorly is if you have to look at the core drivers behind these styles. So in an environment where inflation is surprisingly high, as we saw in 2020, so you know, for years inflation was always talked about as being inevitable, but in 2022 we saw the inflation chickens coming home to roost in dramatic fashion. Now pair that with central bank reactions to the high inflation. You saw in the US the Fed was aggressive in its tightening. In fact, a lot of analysts are today saying they were overly aggressive or you know, had a great fervor in tightening their policy. So pair the two and you see high inflation, high interest rates. Now, why would this be bad for growth strategies? So let's unpack this for a second, because it's important to understand where the drivers of return comes from. A typical growth sector or growth company is generally, we think of it as being a proxy for high future potential, right? So that's why we call it the growth company, because on current price multiples, for example, it can be considered expensive. But if you look at its potential, that company might grow so much in the next few years that tomorrow's price looks cheap in today's terms. It's a very simple concept to understand. High potential has a high premium to it. Now, in an environment where inflation is higher, this simply means that the opportunity cost of not materializing those future returns gets higher. In other words, if I look at an Amazon or an Apple and investing in that, or you know, any sort of traditional growth type stock, then my alternative has suddenly become more attractive. So a higher yielding bond market, for example, all of a sudden becomes a more attractive investment alternative. So your growth strategies have that higher opportunity, that opportunity cost that they need to deal with. Pair that with a higher interest rate, and all of a sudden your future discount rate, so those high promised future earnings, all of a sudden are discounted at a steeper rate back to today. So that means if you combine the two, it's almost a perfect storm for growth strategies, where all of a sudden you see risk taken off the table, a massive risk on approach in 2022, a lot of uncertainty, a disconnect in energy markets, and the question, how long will inflation persist? Is inflation here to stay? Are we seeing a new normal in terms of price rises in developed markets? And also, how aggressive will central banks tend to be in the future? So all of this taken together means that it's really been a challenging time for growth sectors. Now, the exact opposite applies for value, right? Value tends to be your longer term strategy, where you have your traditional blue chip companies. might be a bit boring in up cycle times or bull markets, but you know they're going to be there tomorrow and they will deliver on earnings. Not as spectacular as a growth sector or a tech stock, but they will be there tomorrow. Now all of a sudden those companies become more attractive, and their slow but steady earnings become more attractive, and so investors are drawn towards that. So we've seen a flow out of growth strategies into value strategies. And that really sums up our view of the market and why certain sectors performed and why certain sectors underperformed.
Well, to put you on the spot, do you think value strategies are going to continue to outperform in 2023?
Well, that's the $1 million, I suppose the $1 trillion question really is, will value continue to be a driver of performance in this year? I wish I knew, and certainly if I knew that, I would probably not tell you. I would be running to the hills and investing or building a fund to take advantage of that. But in all seriousness, this is a very important question. Will value continue to be a driver of returns? Now, with all that we've said up to now, and also what I prefaced a bit earlier by saying that your growth-orientated strategies, which includes most of your developed market strategies, MSCI, S&P 500, Nikkei, Nasdaq, the like, all of them have a distinct growth flavor to it. So it's very important to get your predictions right on how will growth actually perform relative to value. If I have to whip out a glass ball and make a prediction, I think you have to start by what inflation is going to be, what's going to be doing this year, and also how the Fed will react to either a more moderate inflation outlook or a even more hawkish inflation outlook. So that remains to be seen, and I think to a large degree inflation will continue to be the tail that wags the dog. We've seen very recently, and more market data is coming out confirming this, that inflation is easing in developed markets, and so a lot of analysts are saying and clamoring and saying that the Fed was overzealous in their tightening, and it's becoming politically more unpalatable for the Fed to continue on their tightening cycle. For two reasons. One is that inflation is moderating, and the second is that you see historically high corporate and sovereign debt levels. So it's becoming more painful for the Fed to hike interest rates the way they are doing. But it will remain to be seen whether prices can stabilize. Of course, whether the geopolitical tensions that we're seeing globally will stabilize. And if we see this happen, if geopolitical tensions stabilize, prices start to stabilize, central banks start to moderate their tightening, certainly we will more than likely see a recovery in growth stocks and sectors and some more gain there. But I would always caution anyone investing in these type of strategies and using these styles as building blocks to just be well diversified. Hold a combination of, for example, EM in addition to your DM, and just be diversified.
Yeah, Nico, you're talking about diversification. We spoke about the markets being very volatile or choppy. Kingsley, can you maybe give our participants an idea, first of all, of Satrix's investment philosophy to navigate these uncertain times? And maybe talking to diversification, give us an idea how it played out in terms of the performance of the two multi-asset funds that you do offer.
Yeah, thanks, Gielie. So let me unpack the first part of your question. What is Satrix's investment philosophy for navigating all of this complexity? It's a question that we come back to repeatedly as we face the ever-changing and dynamic markets. But what we rest on is the fact that research has shown that 90% or up to 90% of your long-term returns are going to be explained by the exposures you have to various assets, and ultimately what that mix is. In other words, what is your strategic asset allocation? So that is the most important thing to decide on and make sure that that's appropriately matched to your investment horizon and your risk profile. I guess we follow that old cliche of, it's about time in the market, not trying to time the markets. And we very much subscribe to that. So we go about designing solutions that focus on getting that strategic asset allocation right for clients that fit within a particular risk categorization or to achieve a particular risk outcome or tolerance. So that would be the first thing. And I mentioned that your time horizon is such a critical factor. And so this was some work I did last year for a client, and hopefully this is not news, but I think it's interesting nonetheless. So the first bit of work I did was to look at what is the probability of delivering a negative return over different rolling periods. So 1 year shown in dark blue, 3 years in yellow, 5 years in pink, and then in orange over 10 years. So different rolling periods over the last 20 years. And unsurprisingly, in risky asset classes or in risky indices, over a short period, you have quite a high probability of delivering a negative return, 20% of the time. 1 in 5 chances on looking at monthly returns, it'll be a negative return on a rolling 12-month basis. But as you expand your investment horizon to the medium term, you see that probability drop quite dramatically, particularly for local equities. And as you look over the long term, so 5 years and beyond, so up to 10 years, that actually drops down to 0%. So what that means is that over any rolling 10-year period, any 10-year period that you consider over the last 20 years, you've never had a negative return from our local equity market. If you look at a more defensive asset class like nominal bonds, as represented by the Albee index, you can see that that's a far less risky asset class. So you only have to go beyond 1 year into the 3-year space, and you're always in the green. But what was also quite interesting is that, despite the standout phenomenal returns that I showed earlier of developed equity markets from MSCI World, you still have a residual probability of delivering a negative return in absolute terms in rands, despite the phenomenal returns that we've had from MSCI World over the last 5 to 10 years. But the more interesting question is, because as I mentioned earlier, we invest to deliver an inflation-beating return. So yes, we're worried about absolute losses, but what we actually should be more interested in is what is the probability of not keeping pace with inflation? So that's a higher hurdle, because not only do you not want to deliver a negative return, you want your return to be at or in excess of inflation. And so that's what's shown on the right side of this slide. And you can see obviously the probabilities are higher. So if you're only going to invest for a year, a third of the time you could be making a loss or a real loss. In other words, a return lower than inflation. And this just comes back to the importance of making sure that you have an appropriate investment horizon when investing in asset classes. And I think clients are often tempted to switch out of their investments, particularly in risky segments of the market, which I always go back to a famous quote by Professor Eugene Farmer, is that if you're looking to exit your risky assets after a negative return, well, you probably shouldn't have been in those risky assets in the first place, because the probabilities are quite high that you're going to have a negative return over a 12-month period. You need to give it 5, actually even more than 5 years to have real confidence that you're not going to deliver a negative return. And we see the same thing even with investing offshore. So investing offshore is not a slam dunk. You can see there's still residual probability on a rolling 10-year basis that you might not keep pace with South African inflation by investing offshore. So those are some quite interesting findings. And I think just talking a little bit about investor behavior, understanding this helps us avoid some of the behavioral biases and pitfalls that we all fall into as investors. And I'll be unpacking this a little bit more in Investment Forum later this year. So, if you have the opportunity to join us for that, please do register for my session. So, moving on to the second part of your question, which is, how have our multi-asset balanced funds navigated these choppy markets? So just to explain this chart, this refers to the performance of our A1 class. This is the retail class against similar retail class funds in the category, in the high equity multi-asset category. And we've again looked at various relevant subsets that we believe investors would be interested in comparing our fund to. So in the light blue bars, you'll see an equally weighted blend of the largest 10 actively managed balanced funds. In the red bar, that's the median of the peer group overall, the median of the category. And the yellow bar represents, I suppose, what are our direct competitor funds, other balanced or rules-based index balanced funds. And then just to highlight one other little bit of information on this chart. So the dark blue bars is the Satrix Balanced Index Fund. At the bottom of each bar, you'll notice what our rank is relative to the number of funds in that category over those different periods. So obviously more recently, there have been more funds in that category, 207. we were the 90th best performing fund of those 207. But have a look at how excellent our performance has been on a ranked basis as you expand that investment window to 3 years, to 5 years, to 7 years. Over the last 7 years, we've been a top decile performer, and that is incredibly difficult achievement. And I think what I take great comfort on is that in our particular investment philosophy, we don't try to time the markets. We focus on getting our strategic asset allocation right. And this is supposedly the segment of the market where the most value can be added through both stock picking, active management, as well as tactically allocating between different asset classes. We don't do any of that, and yet we've been able to deliver this phenomenal performance.
It comes back to the question you had earlier. Is it purely a cost phenomenon or performance phenomenon? If you look at these, the dark blue and the yellow bar, this is where you're seeing 1 in 3 rand being invested in this segment. So you're seeing flows, but it's not purely on the basis of low cost. It's also on the basis of performance.
And this is another way to visualize that data. So this runs from the inception of our fund, and I think we'll be coming up for our 10-year number this year. So watch that space. But this looks over different rolling periods. So similar to what I showed you across the different benchmarks, this now looks at the rolling performance over 1 year, 3 years, and 5 years of our fund, the Satrix Balanced Index Fund, relative to all of the funds in the category, and how often it is in the bottom half, the top half, the top quartile, and the top decile. And you can see that as you expand that investment window to 3 years or to 5 years, we're never in the bottom half. And you're outperforming up to 95% of funds on an asset-weighted basis with a high degree of consistency, a quarter of the time, sitting in that top decile, that elusive top decile of performers. And that's the longer you're invested in our fund, the more probability you have of being in that space. So we're delighted with the performance that our fund has delivered since its inception. And then just to touch on our low equity balance fund, so this would be for more conservative investors who don't want to take, have as much exposure to risky assets. It has a far more conservative strategic asset allocation with much lower exposure to risky assets like equities. Bit of a tough year. We weren't quite in the top half over the last year. So we'd want to obviously see that improve. But have a look at how the fund has done over the medium term, over 3 years, 5 years, 7 years. Again, it's completely held its own. And this is despite some improvements that we've made over the last 3 to 5 years. So prior to that, the fund was probably not performing as well as we would have liked. So we have introduced some changes, such as enhancing the yield pickup in our cash exposure, as well as last year introducing the Smart Core equity strategy within our local equity exposure. So we really expect this fund to continue doing well and adding value relative to peers like we've seen take place on our balanced index fund. And
where you can see the pain in the last year has been us not being exposed to property in this sector. So that certainly would have, the property sector has bounced quite significantly in the last quarter especially. So there we do see some underperformance being materialized there, but over the medium to long term, we still believe that to be strategically the right decision to reduce our property exposure.
Yeah, so Kingsley touched on one of the tools is the strategic asset allocation, but also then you mentioned Smart Core as a differentiating factor. You often talk about the secret sauce inside the balance funds. But before we get there, Nico, you talked a lot about value growth, almost gave us a little masterclass on that. But if we look back into 2022, what was the experience overall from investing in various factors? Can you maybe from a performance perspective just highlight how the various factors have performed over the last 12 months?
So factor investing had a particularly challenging year in 2022. In fact, I'll show you a slide later that suggests it was the most challenging year in the last 20 years for factor investing. But before we get to specifically 2022, I want to show you over time the experience of style investing, or factor investing, however you want to define it, and the lived experience in South Africa. So firstly, if we look at the value versus growth spread, and if you recall, I showed you a few slides ago the performance globally of the MSCI value versus growth. If you thought that was dramatic, hold on to your seats. I mean, the value spread currently relative to growth is at its highest level ever in South Africa. You see a very, very high, excellent performance of value relative to growth towards the end of your sample. Now, what is interesting is if you look at the performance of growth since 2012, in fact, the underperformance of value has been acute in South Africa. Very few periods, actually on a rolling basis, did we see value managers perform well relative to growth as a style. Only recently has value started to pick up again. Now, if we look at this momentum as a style, now historically momentum has been an excellent investment strategy in South Africa. The zero line, that's the capped SWIX, and the blue line is the performance of the Satrix momentum index relative to the capped SWIX. So you see all the way from 2010 to 2020, it's all been momentum and it's all been growth. Now, if we look at the performance of our value indices, and this is particularly interesting to see how well actually our value indices, so the RAFI and the Divi Plus, have done in capturing these value trends. So if you look at the periods between 2009 and 2011, excellent performance for value strategies. This is when our value indices performed well. And then again, from 2021 to 2022, as I mentioned, it's all value. You see our value strategies did exceptionally well. In fact, our Divi strategy is one of the top performing within the entire equity investment space. So certainly we're able to offer investors the ability to capture this value strategy quite well through our offering there. Now, if we look at quality, and this has been the style that has seen the most dramatic underperformance in the last year or two, and certainly investors that follow style trends would know that globally this is where the pain was felt as well as locally. So, and this is primarily almost due to profitability as a metric being captured by this style, because highly profitable companies have to take risk in order to be profitable. So the first area of pain you see within the quality bucket, if you like, is within the profitability side, because when there's a risk off or interest rates start to rise, that's generally where you see investors start to reduce their exposure to highly profitable as well as highly geared companies. So for that reason, you see the S&P quality index underperformed quite a bit from 2021 towards the end of 2022. Now, this is one way to look at it, the lived experience. But what I mentioned earlier is that 2022 was the most the most challenging period for multi-factor strategies in our history. And I want to show you, because you can't look at it from a performance perspective. Because if you look at the performance of a multi-factor strategy, there's a lot of risk mitigation being employed that's hard to know what part of the performance is signal and what part of the performance is risk mitigation. So if we just look at the performance, the signal clarity or the signal strength of our multi-factor index, what we did here is, and there's quite a significant bit of work behind this very simple graph. But what we do here is since 2005, we looked at every single JSE index rebalance, quarterly index rebalance, and we ranked the stocks in the large and mid cap by their Smart Core multi-factor score. So our Smart Core multi-factor score, if you recall, is a composite of value, quality, and momentum. So it takes a composite for each of the companies, assigns a multi-factor score, and then each bar represents, on the day, we rank by this multi-factor score, and then we take a correlation between that ranking and the next quarter's return. So in other words, if it's March 2005, then we rank by the multi-factor score in March 2005, and we correlate that to the returns of those same stocks from March to June. Now, if that correlation is 100%, of course, that means that the multi-factor was a perfect predictor of future rankings. So if you follow the train of thought here, that means there's no portfolio construction element here. It's simply an indication of how well the signal is held up. Now, over time, the signal has actually done extremely well. Specifically from 2010 to 2020, very few quarters actually was it not a good indicator of future performance ranking. Now, you might ask, how much is good? How long is a piece of string? Well, the global literature suggests that an average information coefficient of about 5% can be considered very good, a very good signal. You can see that our multi-factor signal over time has been about 7.7%. So that's very significant. What is interesting, though, is if you look at the first quarter in 2022, that deep negative blue bar, and the blue bars are since since the inception of SmartCore in its current form. Now, what you can see is that 2022 Q1 was the worst period for multi-factors. In fact, the signal was the most negatively correlated with future returns. And remember, this coincided with a period where quality was struggling, so there was a flight to safer, like blue chip companies, as I mentioned, globally we saw that was the case. And of course, momentum nearly capitulated in Q1 2022, simply as I put before, that momentum takes time to pivot, right? So there was a massive dramatic change in market fortunes and quite a bit of pain felt there. So no surprise that your momentum and quality indices struggled. Value added quite a bit of upside there, but still, two of the factors did extremely poorly. What's interesting though is that the multi-factor signal recovered towards the end of the year, again showing that towards the end of the year this again was positively correlated with future returns. But this is only part of the story, right? Is if you look at the multi-factor composite smart core and the performance, this is where the value of our risk mitigation actually comes to the fore. And you'd think in a year as challenging as 2022 was for multi-factor strategies, we take great comfort from the fact that still, despite this, SmartCore managed to outperform the index that it tracks, the capped SWIX, for the year. And we see this on the next chart. In fact, if you look at it since inception, SmartCore has delivered 10.23% annualized returns versus the 7.7% that the capped SWIX delivered over this period. Now, if you consider the fact that SmartCore has a tracking error, targeted tracking error of 4%, that annualized outperformance of just over 2% means you're getting an information ratio of just above 0.5%, which is by any measure an excellent performance. And so, a lot of our effort goes into risk mitigation and considering means, the best appropriate means to capture the factor, but also to ensure that the fund doesn't lose value when factors does not work in your favor. Because it's important to always remember that no strategy is a perfect strategy, and there are going to be times where you see underperformance. You just have to mitigate the risk very carefully.
Well, Nico, thank you for that. Kingsley, the MSCI World Feeder Fund, you've run a ballot quite recently on that fund. Can you maybe give our investors and our participants an idea what they can expect from this ballot if it turns out to be successful, which I think it will be?
Yeah, we very much hope investors will vote in favor of that. It is ultimately going to be to their benefit. But before I get into that, let's just do a quick update on the fund. There's nothing wrong with the fund. In fact, if you have a look at these consistency stats of our MSCI World Feeder Fund relative to the global equity general category, you can see the performance of this strategy very much aligned with what we showed earlier across the global universe of funds is equally compelling. So on a rolling 3-year basis, you're never in the bottom half, you're always in the top half, with a third of the time being in the top quartile. If you expand that window to 5 years on a rolling 5-year basis since the inception of this fund, half of the time you're in the top quartile, so and never in the bottom half. So that's absolutely phenomenal achievement. So the fund is completely delivered for clients and delivered excellent performance for clients investing and wanting MSCI World exposure as an available option within that global equity category. But we expect that the improvements that we're aiming to bring to clients with this ballot will help enhance this performance even further due to tax efficiency and other operational efficiencies, such as removing the lag in performance that is currently a feature of the fund with the feeder structure that it has. So we really do hope that investors vote in favor of this because it will only make this performance even more compelling.
Well, Kingsley, Nico, thank you very much for your time today, and also thank you very much for sharing your insights. And then all the best for the year. I can honestly tell you, you're part of a very exciting business, very well positioned for a very exciting time for indexation strategies. And we are really excited and looking forward to see what's coming out of the Satrix business in the upcoming years. To our participants, thank you very much for joining us. And until we meet again, have a good day and goodbye.